Karekeba Ventures, I just deconstruct it a bit. It is from not from Japanese or Korean. It is from our very dear Bhojpuri language. So
Right.
Karekeba means we must do it. And we started with this vision that we have to do this. I mean, create an entrepreneurial ecosystem for Bharat, what we call the tier 2, tier 3 India. And through by providing an angel investment platform to startups and impact enterprises, and facilitating investment in them through angel enterprises. Thanks, Nidish. That was a wonderful introduction.
Thank you. And next speaker is Mr. Vinod Shankar. He is based in UAE, and he has been he's a speaker, podcaster, mentor, and startup supporter. He has an investor for various type of funds in the past and startup. He is also board member of CFA Society Emirates. So, Vinod, anything else you want to add? As you have vast experience, and no one-liner can do the justice.
I think for the purpose of this audience, Nidish, I think I've spent a lot of time and effort investing in public, US public markets, public equities rather, and also have some startup investing experience, investing in startups in India on various angel investing platforms. So, and also I'm a CFA charter holder, so I have learned and taught behavioral finance extensively over the last 10 years. So happy to be here.
Great. Thank you so much, Anubha and Vinod, to have you as the speaker on this platform. And I'm sure the audience will benefit, those who are listening now or in the future through various social media platform, because this is a very pertinent topic. The market is continuously going up and down, and somewhere it also relates to the emotional behavior and the investor's own anxiety and emotional triggers. So it is a very relevant topic nowadays. And with that, I would like to first start with the fundamental question as to what is the behavioral finance altogether, what it is, and how we can differentiate this from the traditional finance, because we have seen historically CAPM, capital asset pricing model, etc., have been quite reliable in the past, at least seem to be reliable. But now with advent of behavioral finance in the discussion, how we can differentiate these two? What is the difference between the behavioral finance and the traditional financial theories? So Anubha, is that something you can share, your experience?
Yeah, I started speaking, unmuting myself. Thanks, Nidish, for that question. So when we talk of behavioral finance, it is so intertwined with our, lives and our day-to-day experiences that at times it's very difficult to, separate the two. How we behave in the domain of, finance investment decisions. So basically, behavioral finance is a domain. It is a discipline which tries to define this entire thing and tries to dig out the irrationality, the rationale behind the irrationality of the investor behavior. So if I can put it very simply. And of course, there have been several explanations of investor behavior in different kinds of markets, be it capital market, or be it secondary market, or be it private equity, or be it public equity. So there have been different kind of studies, but the way the investor behaves, at times it is very difficult to predict or see a pattern there. So this is precisely what behavioral finance attempts at doing. So if there are irrational behavior the investor is displaying, then what could be the rationale behind such an irrational behavior? So whereas in traditional finance, we assume that the investor is a rational person who can process all the information unbiased at his or her disposal. And whereas in behavioral finance, we draw from real life experiences, stating that an investor has biases. Investor is irrational, and his emotions do have a role to play, wherein in the kind of real life investment decisions. So, in terms of traditional finance, we can say that investors are rational decision makers, wherein behavioral finance investors are, normal decision makers influenced by, their nurturing, their nature, and everything, and their own experiences. So, as per traditional finance, investors have perfect self-control, whereas in behavioral finance, they are not always driven by data and that kind of stuff. So it is limited self-control. Uh, so we assume in traditional finance that the investor is risk average. However, as per behavioral finance, the investor has very varying kind of risk preferences, and it can also regret losses. So the basic assumptions of traditional finance: people process data appropriately and correctly, people view all decisions through transparent and objective lens of risk and return, and people are guided by logic, reason, stats, data, etc. Whereas in behavioral finance, we factor in the imperfections and the rule of thumbs, the biases which to process data, and their belief system as well. And the perception of risk and return is significantly influenced by how the decision problems are framed, and emotions and herd mentality, herd instincts often play an important role in investment decisions. So that's my take on it. I'm sure Vinod will have a lot to add, being an expert, a domain expert. So Vinod, over to you.
Yeah, thanks, Anubha. It has been very insightful. But because, yeah, as we know, different community, even the cultural bias, age group, everyone has their own emotional reserves while reacting to any market incident. So that brings us to the next question. Coincidentally, we have seen in last 1 year, market has been going from top to bottom in few weeks' time, and it has been it has seen massive ups and downs in the capital market globally. So, looking at that from the perspective of behavioral finance, what are the key lessons that we have observed and learned from the market in last 1 year? And that's a question to Vinod. With reference to the market, what do you think the lessons are? Thanks.
Thanks, Nidish. My reply is going to be rather long. I think people have to be patient because there are so many things that you could have observed over the last 1 year, right?
Looking forward, Vinod.
So let me start from, there are a few years in history where the path of the markets and the path of human experience has diverged more markedly than last year, right? In mid-Feb to 2020, the market was trading at what was then all-time highs. March 23rd, 2020, the market bottomed after a very sickening 34% decline, right? So behavioral finance remains a fashionable area of the dismal science economics, right? It distills down to two truths, right? One, that emotion trumps rationality, and two, that mental ready reckoning beats rigorous thinking. That's the two very basic essentials of behavioral finance. Now, behavioral finance also talks about biases. I think Anubha touched upon that earlier. I think she'll go into a few more biases in detail later. Biases are basically, for lack of a better word, dysfunctions or flaws in the way we think compared to the way we are supposed to think, which is using rationality and all those things, right? So if you think about what happened in March, I think the first bias that I can think of personally is regret aversion bias. Let me explain that, right? Most of us are essentially cautious or essentially aggressive. Probably more people are essentially cautious than aggressive, of course, yeah. Now, what they don't do, what I didn't do, is turn aggressive at the bottom of the market. And it's common not to do so, right? It's common for people to say, I'm not going to jump in while this thing is collapsing. I'm going to wait until the dust has settled and the future is clear. I'm not going to try to catch a falling knife, right? And I completely see that, right? I was terrified as well. But it is when the knives are falling, when stock markets are plummeting, and when the people are most terrified, that the best bargains are available. If you wait till the dust settles, the bargains are gone. And even now, I look back into March, sitting now and think, my God, why didn't I buy those fantastic bargains in Amazon or Nvidia or Netflix or Apple? which are trading at, unbelievable prices. But then, that is regret aversion bias, the fear, as in to be aggressive and staying cautious when you should actually be more aggressive, right? The second bias that you would have seen, again, coming from my own experience as well, right? This is not just theory, is what you call over-analysis and error of omission. Now, typically when I invest in US stocks, typically, I do a lot of research and information gathering, right? And you go into research reports, news reports, podcasts, all those things. But where it's always hurt me is when it comes to taking action. I often in the past have missed out a good portion of the upside, right? By attempting to do more research. And by the time you've done more research, especially in the last 1 year, the market was moving at a fast pace. So if initially you were looking at a stock and had a 30% upside between the market price and the fair value, by the time you do research, it's only down to 11%. And I have a basic rule that I will not invest in any stocks where the upside is less than 20%. That is just my rule, right? I want a safety margin, a decent safety margin. So what happened is I lost out on that. And I think that's the case with a lot of people as well, right? Yeah. So also I found that, most of I will do a little more research kind of work is often in order to seek out information that might help me, but doesn't really affect the original investment thesis. Looking back, I don't think my additional research changed my view of the stock or of the fundamentals. So it is not that useful delaying it by that much, right? Okay. Now, so I can think of multiple instances, right? Going from Pinterest or talking about companies like Peloton. I could put a big list of stocks, which way back in June, July, August, even last year, were decent bargains. And then they took off, right? So now what happens, of course, after they take off, I could purchase them at higher prices, but then my conviction is less now. I know I have a lack of conviction at that point, right? I always think about, okay, I'm buying it today at $65, but I could have bought it 3 months ago at $35. And then you find that, you lack confidence about the entry point. Right? So this is what you call the dreaded, I missed that one error of omission, which can be very costly. It's not that you make a loss, but you have basically foregone significant upside. It's like an opportunity cost. And again, with me, it happened quite a few times, right? The other bias that I thought about, which happened to a lot of investors, is confirmation bias. Confirmation bias basically is investors look for information or news that confirms their original thesis and ignores any news that does not confirm the original thesis. So what happens, of course, when a crisis is unfolding, whether the market is going up or down, everyone knows, right? We all spend too many hours reading or watching the news, CNBC, Yahoo, CNN, whatever, right? And of course, when volatility is high, we actually pay more attention, right? We also tend to overreact to news that is recent, prominent, or easily accessible, right? So in case of confirmation bias, during the downswing, I know a lot of people I know who sold in a panic because all the information they were getting was negative and there was no positive information, right? So that made them sell. But also on the upswing from March till today, if you look at what's happening, one reason I think why stocks have gone up a lot is because people focus on the positive, that, the secular growth story and the high margin story and, the reopening story, whatever. So I think that's a very important, common flaw that you see. You don't want to find out any bad news about a stock that you hold. You only want to find out about the positive news. Even if there is bad news staring at you, you will not click on that link. I know that I've done that many times before. You will tend to click on the link that says further upside, and analysts agree, and good news for the stock, things like that, right? So that is one other bias, confirmation bias. One bias that has especially is common for young people, right? Anyone who started recently, when I say recently, I mean if you started investing in say 2009 or 2010, right? Now this is called availability bias. Now the young investor has experienced almost nothing of markets, right? I mean, think about it. He only knows about one environment over the last 10 years, and that's one of declining and low interest rates, negligible inflation, dominance of passive investing and ETFs, and considerable outperformance of a small circle of large American companies. We're talking about the FANG stocks, Facebook, Amazon, Netflix, Google, Apple, and Microsoft, if you want to add that to the list, right? So this young investor has never experienced things like rising interest rates, which is experiencing now, high inflation, which again is probably happening now, the American stock market lagging behind the rest of the world. He's never experienced a change in currency regimes. He's never experienced significant tax increases, high commodity prices, collapse in the valuation of high quality companies, a credit crunch when no financing is available to anyone, markets that are long trading below their average historic valuations. Right now, they're trading above the historic valuation, right? An extended period where growth stocks lagged behind value stocks. So right now, if you look at the last decade, growth stocks have been beating value stocks hands down. But people have not seen the opposite, which also actually also happened in the past, by the way. He has not seen massive wave of bankruptcies, for example. And I can go on and on, right? Now, this lack of experience is a huge disadvantage to a young person because he's only seen one part of the story. He's not like Warren Buffett or David Tepper, who has actually analyzed and been working in the stock market for the last 60, 50 years. And they've seen many ups and downs. So availability bias is the bias whereby investors only recall information that is available. And available information is based on their experience. And a lot of available information is based on recent experience. So you can imagine the havoc that that does. Basically, you're investing or not investing based on what happened to you recently, which of course is not the entire history of the stock market or the bond market. And then of course we have what we call, and everyone knows is right, herd behavior, right? One guy does something, then 10 people jump on the bandwagon, right? And if you look at the US markets, the biggest, most liquid market, right? Till very recently, and when I say recently, I'm talking about maybe mid-Feb, when yields spiked and growth stocks plummeted. Till very recently, it's very, very easy to make money in US stocks, right? Most retail investors could post fantastic profits blindly by buying the most popular stocks or buying the biggest IPOs or buying cryptocurrency, blah, 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 right? Buying into hot industries. So they were all trying to identify trends, trend leaders, trying to identify which industries are the hot industries of the future and which companies would be leading those industries, right? Without any fundamental analysis of significance, right? So what happens is everyone identify the same trends and same industries, and they frequently buy the same companies as well, right? Now, what happens is then everyone agrees with you, everyone agrees with everybody else, and everyone is heading in one way, in one direction, which is up, right? There's complete consensus. There is no disagreement, basically, right? Now, at this point also, I want to talk about what you call how the human mind works, because like Anubha said, right, this is not traditional finance. This is very much, behavioral finance is very much a product of how we think. And we are quite flawed and quite irrational in the way we think, right? The human mind is wired in a way that makes bubbles and crashes inevitability from time to time. I'll tell you why, right? So the human brain is wired to exert as little input to get as much output as possible, right? Take ROI, right? High ROI. Now, this makes a lot of sense when trying to allocate a finite amount of energy, but it leads to some very interesting behaviors, right? And one behavior is it is easier to copy others than to do something yourself from scratch, leading to some things like, groupthink and social proof bias, and like this bias I mentioned, herd behavior. So in normal times, our prefrontal cortex is usually able to think for itself. Our prefrontal cortex is the front of the brain where thinking happens, right? When something doesn't make sense. But during times of stress and greater uncertainty, which is what happened in the last 1 year, our prefrontal cortex functioning breaks down, reducing independent thinking and leading to, and this is very important, leading to increased imitative behavior. And the financial market environment is particularly vulnerable to imitating behavior, since it permanently deals with an uncertain, unknown future. You don't know how stocks will perform, right? And of course, the greater the uncertainty, the more people look to others for answers. What do you mean by others? Analysts, commentators, experts in quotes, right? And what happens as a result is a questionable logic becomes accepted, and a strategy or style of investing takes over. Momentum investing, for example, or investing only in very sexy growth stocks. So this is what you call by herd behavior, where independent thinking fails and positive feedback loops prevail, right? Leading to excess of optimism or excess of pessimism. And of course, as a result, you get extreme market price variations, whether the market crash in March 2020 or the massive increase in the price of a lot of stocks from March to December or March to January this year. Right? That is one other bias I want to point out, right? And of course, if you look at this time between March and December 2020, in the US markets, and then probably Indian markets as well, right? I think a lot of what I'm saying about US markets is applicable to Indian equity markets as well. What happened is people were very overconfident. So you had this overconfidence bias kicking in, right? Like Henry Kaufman, who was the chief economist, I think, of Salomon Brothers way back in the 70s, say two kinds of people lose a lot of money: people who know nothing and people who know everything, right? Very few of us know nothing, of course, but it's very important not to assume that we know everything, right? So sometimes when I look at stocks, I look at a stock and I think, okay, how much optimism is actually baked into the price? How much optimism is factored into the price? When you look at a stock that is trading at a PE ratio of say 50 or 80 or 100, or a price to sales ratio of 30 to 40, and that is taken as normal, and not only that, but you feel that you know everything because everyone is investing, you have seen blogs, you have read articles, and hence you can't lose money, no way, things can only go one way. That is overconfidence bias, and that's the recipe for disaster. So I know friends of mine, so I'm personally not overconfident. I'm as a typical chartered accountant and CFA charter holder, I tend to analyze, maybe even overanalyze. But I know friends of mine who were buying, almost like trading, buying, selling over the last 9 months in hot US growth stocks. And in Feb, when yields spiked and the stocks fell, they were stuck with massive portfolios bleeding red because they were chasing PE ratios, and they were like, this is going to go up for a long while, right? And of course, people like Katie Wood of ARK Invest, who is of course a visionary in terms of how she sees trends in industries. She also, basically her investing style also had followers, and those followers believed in her theory, her vision, and they blindly bought whatever stocks the ARK fund was buying. And of course, you have, last but not the least, you have the anchoring bias. Now that's happening recently, right? So I started this my response to Nidesh's question by talking about what happened first, the regret aversion bias. What's happening now is the anchoring bias. Now, anchoring bias is when investors are arbitrarily, that's very key, right? Arbitrarily anchored to some random number. That typically random number is the price of a stock in the last 1 year, okay? Some high or some low, or maybe returns on a stock. So what's happening right now is stocks that did well during the pandemic, and some of them are really good in terms of product, in terms of target market, in terms of management, in terms of even balance sheet strength. Those are suffering now because people want to achieve the returns they achieved last year, which last year was a super normal year, right? Once in a blue moon. So what happens is people have got unrealistic expectations. So if, for example, last year, Peloton gave you an 80% or 110% return, it's probably not going to happen now because that was a stay-at-home stock. It might continue to be popular, but not to the same extent as last year. It's going to be now, partially stay-at-home. So I think here what's very important is having realistic expectations. As Charlie Munger, the famous partner of Warren Buffett says, right? The key to a happy life is low expectations, right? So it's very important not to extrapolate the last few years' results, especially last year's result, into the future, because then what happens is you lose out on investing in some solid companies, well-managed companies, whose growth going forward may not be in the 80-100% per annum, but still give you decent growth, decent dividend, some diversification in your portfolio, etc., etc. So I think anchoring bias is also causing havoc to investor portfolios and their performance as well. So basically, to summarize, I think in terms of biases, the key biases would be regret aversion bias over the last 1 year. The other bias that I can talk about is error of omission bias, as an over-analysis bias. You've had confirmation bias. You've had people relying on history and looking at availability bias. You have seen, of course, herd behavior massively across all markets, people buying en masse without looking at the fundamentals, right? You had, of course, overconfidence bias, saying that nothing can go wrong. And finally, you had the anchoring bias, right? I'm sure there are other biases as well, but this is what I could recollect, given what I have seen in the markets as I've been active in the equity markets, and what I've personally experienced as the mistakes that I have made, which of course I'm not really massively proud of. And I hope to be able to rectify now that I've got everything in black and white and I've confessed to the public, and Nitish is going to upload the YouTube video. I think that gives me a strong incentive to relook at my investment practices. So yes, that's the answer to your, it's a rather long answer to your first question, Nitish.
Thank you, Vinod. And actually, I was expecting some details because it is a very important question, and I'm sure the audience would have benefited from this. In fact, my next question would also require a lot of your experience. That, yeah, we understood that as we evolved from the forest as a Homo sapient, we're trying to save energy and safeguard life. So we're trying to stay safe. And that's why sometimes taking shortcut decisions, sometimes trying to stay away from the risk. Now, having realized some of the limitations, what would be the potential measures to mitigate this kind of behavior, such as herd or overconfidence bias, this kind of bias, how we can avoid them so that we don't keep repeating these?
Right. So thanks, Nitish. So basically, you're asking about a solution to the biases. So I'll list out a few solutions, right? A few solutions. Again, from my point of view, I think one big mistake I made was this error of omission, over-analysis. So now what I'm doing, Nitish, is I'm trying to refine my thinking and basically make me utilize what you call starter positions of, say, 5-10% weightings in portfolios, right? So what I'm doing is, although however maddening it is to capture a large chunk of upside when I only own a small portion of the business, I get incentivized to know more about the company now that I've invested in the company. So for example, I have a portfolio of stocks currently, and instead of investing, X $1,000 that I used to, I'm now investing smaller amounts in a company that I've not invested in before. Now, what happens then is I have a motive now to track that company. There is a potential to add more down the road as the company executes solidly. And of course, I can hopefully make a bit of money. So that's what I'm doing now. Instead of just staying out completely, 100%, and waiting for my research to be completed, I'm putting in a small amount of money, which even if the company goes bust, I'm not going to be terribly sad if I lose it, right? That's one thing I'm doing now, basically. Yeah, starter positions. Now, the second part, of course, is bias herd mentality. In my case, I was never a follower in the sense of following hot trends or what the fashionable stock. So it never happened to me. But it happened to many people I know. And one of the keys to investing, I think someone mentioned that earlier. I think it was probably Sushil or someone earlier in this talk. One of the biggest keys to investing is to be unemotional, or at least act like you're unemotional, right? Warren Buffett couldn't care less, when stocks come down, right? At least he didn't show it. Now, this is very easy to say, but very difficult because it's terrifying, right? People are terrified. That's why they're selling. And you have to overcome it, right? Now, I'm going to give an answer which is not going to be, that thrilling to a lot of people. I think it's a hell of a lot easier if you're born that way. Some people are just very calm and cool, right? Cool as a cucumber, even if the world is collapsing around them, right? To teach yourself to be unemotional is to basically go against human nature, your human nature. By definition, it can't be easy, right? There's no easy answer here, to be honest, right? So I think maybe one answer to that would be at least be aware that you're emotional, at least be aware that you could panic. And maybe that awareness could sort of build in some guardrails or some resilience in you, right? The other solutions I would have, Nitish, is about availability bias, right? Now, availability bias, that is more straightforward because this bias happens because you're only looking at a very short-term history. Your backward view is very myopic, maybe last few weeks or months. So I think the answer here would be look at history, not last 5 years, but last 10 years, last 20 years. You will see cycles, you will see trends. I mean, yes, economic regimes have changed, but some things never change, right? I mean, greed, hope, and fear don't change, right? And some correlations in the market don't really change even after 50 years, right? Another thing what I've done now, which is probably useful to the listeners today, would be to reduce the noise. So earlier, I used to track my portfolio daily. Forget daily, I used to track it like every few hours, right? Except when I was asleep. And there are so many apps available these days. So it's very good. Look at what is the price, gone up, gone down, holdings, percentage, absolute amount, and look at the news. So now what I've done, or what I'm trying to do, because I don't think I've reached there yet, is try to look at my portfolio once a week. Now, that's not easy, but I don't care how whether the market goes up or down. And fundamentally, I'm able to reduce the noise because, like I said, I never followed fashions or fads, or I never chased returns. I basically invested in some high quality stocks, well managed brands, etc. So I don't mind looking at it after a week or 2 weeks. So I think one solution would be reduce the noise, but before you are able to reduce the noise, make sure that you invest in solid stocks. So you don't really care even if the market shuts down for a couple of weeks or a couple of months, right? And the last 2 points are so, I mean, what do you call commonsensical. One is think long term. I think if you have a trading mentality, you'll always be worried. You'll always be stressed out by market volatility. I think I invest, I don't trade. So I buy and hold and exit only if I have to. When something is disconnected to my thesis, my original thesis. And the last solution would be, again, something that everyone should be doing anyway, is diversify. So initially my portfolio was mostly growth stocks, but over the last 6 months, especially after the reopening stocks came in, and after the value stocks started kicking in, after cyclical stocks started increasing, I added stocks like in retail or in healthcare, and not just tech stocks. So that's probably given me some buffer from the recent volatility. I can't claim to have a perfect portfolio. I can't claim to be the perfect investor. This is just my experiences and my solutions. So that's the answer to your second question, Nitish.
So
Okay, thank
to
you.
add to what Vinod is saying, I mean, you are very right when you say that it is against human nature to remove your emotions and remove your biases and keep them aside and take a perfectly rational decision. It's not possible, humanly not possible. That's perfectly all right. But if you are a bit self-aware in terms of that if you tend to overthink, or if you are over optimistic about something, so if you are aware of your own biases, then probably that's the first step towards mitigating those biases. So there's a common bias called the Gamber's fallacy, wherein we see patterns where none exists. So
Right.
these kind of biases, I mean, even if you have access to data or access to stats or historical records, even then you are prone to seeing kind of patterns. So that could be mitigated somewhat easily. So be very rational in terms of spotting those trends or those patterns. And secondly, let us not overestimate ourselves to control events, because there are certain things which are beyond our influence or beyond our power. So it is, let us accept that fact, and let us move ahead with, as Vinod suggested, maybe a diversified set of portfolio, doing your own SWOT analysis, mitigating those risks whenever you can, and not only, and different asset classes, of course, not only in terms of secondary market. So like I'm invested in stocks a bit, mutual funds, real estate, and startups generally. So that also gives me some kind of leverage or some kind of risk mitigation. Over to you,
And
Nidhi.
going back to what you said, Anubha, I think one very important point that you touched upon is, I think you should know yourself as an investor, right? I mean, I'm sure people ask you, they ask me, right, what should I invest in? Actually, that's the wrong question to ask. The question is, what kind of investor am I? And then you can answer the other questions, right? So if you are risk averse and your return requirement is low, please don't invest in growth stocks. Please don't invest in equity even, probably, Or
Yes, not
I mean, invest in
that's high
maybe
risk
bonds or
asset
fixed deposits or mutual funds, maybe,
class.
Essentially, it is about knowing ourselves, like our own risk
Correct.
appetite, risk reward profile, long term versus short term. If I need some, I have kids to invest into their education, probably I can't go too long term. I have to get something that can be sold in some time, and I can bear some risk. So this kind of understanding is required about ourselves. So even if I know that, okay, one of you would give me the fantastic advice to invest, probably you cannot be as good as my own mind to tell me what is my requirement. And yeah, you can be a good advisor if I tell you that, okay, this is my risk and reward expectation, this is what I want the cash flow to come, and this is where I think we all have to be aware of our limitations. So that actually brings me to another question, because it often happens in the market that there are some other impulses, basically, and that could be endowment effect. We kind of love whatever we have too much, or disposition effect. So Anubha, over to you. What is your experience and what is your thought on how endowment effects and disposition effects can also twist our decision making practically?
Yeah, absolutely. So it's there because whatever I have that's dearer to me, so I tend to value it more. So endowment effect basically comes from the thought process that whatever I have, it's more valuable, and whatever same thing, same stuff if somebody else has, that's less valuable. So it's there, and I guess it is seen in real estate a lot that if you are going as a buyer, then you put a different price to a property, and if you're going as a seller, then you put a different price to this. So that bias is there, and it is again, see all the questions have the same kind of answers, so you have to be more rational. Even if it is disposition effect or endowment effect, rationality is the answer, and you can never be 100% rational, but you can try and be there, you can try and better yourself. So when we talk about disposition bias, it is like we have a tendency to hold on to our losing assets, losing stocks or losing trades for too long. So we are probably deferring the inevitable, but then at the same time, we tend to exit our profitable portfolio earlier than it should ideally be, and we delay the loss making assets. We don't book, we don't sell those stocks, or we don't take positions in those. So that's the disposition effect. And again, this is, I guess, answer to every question is that's human nature. We tend to do it, but it's again, you have to be little, for lack of a better word, I would say little ruthless and more objective in terms of having a similar kind of perspective on both your assets and others' assets, or in terms of having a similar kind of perspective in your losing assets or your gaining assets, and find the right time. And as Nidish said, it is, of course, milestones are very important in your life. If you have certain milestones, if you need certain amount of cash flows for meeting those milestones, again, don't do something which is too risky, which will compromise your achievement of those milestones. So all sorts of biases are there, as Vinod touched upon many of those. We all know that we prefer those restaurants wherein there is a lot of crowd. We will not enter a restaurant which is less crowded. And from my own experience in private equity and startup financing, I'm seeing this a lot. So there are people who invest in groups. So if he or she is investing, I'm also in. So it's completely this is the game. Very interesting bias I've encountered. I'm not sure how to name it. There's this IIT bias. So particularly in startup industry in India. So when I look at different founders, so today I was having a session with the founder who's a non-IITian person, but the startup has done exceedingly well. And they recently raised about 100 crore INR from biggies. I mean, Avishkar and CDS, etc., etc. But then the founder is not from IIT. But then there are certain investors in anyone other than IITians. So it's a very strange bias, but it is there. And I'm not saying that this is totally wrong. It's not. But then there are exceptions to the rule. Always exceptions are only they are proving the rules. So that's what, and several other biases which I see in the startup ecosystem, like founders bias is very common. So people don't tend to look at the numbers and hard facts and say that I like the founder, I like his face, I like his body language, then probably this is going to work well. So I'm giving examples from the startup ecosystem since I'm working there, but I don't think any other asset class is as prone to biases and irrationality as this startup asset class is. So over to you, Nidesh.
Thanks, Anubha. A lot of practical aspect of your own experience in working with the startup founders. Yeah, and this is something that we often hear, that many people complains that their merits are not considered because they don't belong to a particular kind of group or tag. And that is again based on maybe some sort of confirmation bias or the herd mentality or some sort of emotional biases as well. So that also brings me to another question I had is, as we know, no matter how much we try to train ourselves, we will stay emotional and some weaknesses will never go. Can we say that some of the solution to our own emotional demerits could be the machines? Because one of the suggestion always comes that if we give the data to some artificial intelligence enabled tools and trading equipments, they can take probably the better decision as compared to us, because they would not have disposition or endowment effects or confirmation bias or even hindsight effects, those kind of subjectiveness. So can that be a good solution in the future? And before
Because,
I yeah, sorry, go ahead.
sure, because we'll be able to answer it well. And of course, we all know what role AI ML is playing in our lives. But which AI ML could have predicted COVID a couple of 18 months back, or maybe 16 months back even? Nobody. So there are always factors which can completely bring the market in reboot mode. And there are several factors which cannot be factored in by AIML. Of course, it is of course, since it is not prone to biases and emotions and other things, and probably it is an answer. But then again, you have to kind of, I would say that you have to balance the two, maybe at times. So just look at it. I mean, when COVID triggered before in the pre-COVID era, we all were doing all our virtual meetings and conferences on Skype. And today Skype is nowhere. I mean, Zoom has overtaken everything, and Skype is with Microsoft. So at the time, probably an investor would have thought of investing in Skype or more than Zoom. It was more popular. But then if you go into the company details and data and the strategy, what is Microsoft trying to do with Skype, maybe adding too many features or whatever, it is not as simple as it used to be. So, and Zoom is now, it's taken the lead role. So it's not always, not everything can be predicted by AI/ML. That's my firm belief. But of course, it is to some extent, it is possible. So over to you, Vinod.
Yeah, good. Thanks for that. Good answer. Nitish, I've got my view on that. I've got 2 points, 2 answers to that. Right? One is, all this AI ML is ultimately written by human beings, right? So it won't be unusual or unexpected for human bias to creep into any code, right? It's not, codes don't write themselves.
Yeah,
right?
that's one of the problems.
Right? They don't, I mean, it's written by some guy, doesn't matter whether they went to MIT or IIT. He's basically written the code, and basically, or a team. That's my number 1 point. So you can't say it is unbiased. There is always a bias coming into it. And number 2, and this is actually more dangerous, is that if you have a proliferation of AI/ML programs out there, and there are already lots of AI/ML programs out there, and they are programmed in a similar way, and what happens then? You have herding behavior. When the market goes down, all the programs automatically start selling, right? What happens is the sell-off becomes worse. Or if it is going up, it becomes, so basically market swings are amplified by the actions of these automated programs, right? Algorithms, what you call them, right? So unless, of course, you have a proprietary algorithm which no one knows about, like Jim Simons, this famous mathematician of Medallion Fund, who has been successful for the last 35, 40 years. No one knows how it does it. Okay, hopefully it is legal. But assuming it is legal, that's the only way where AI ML would be what you call separate. Right? But even there, I've been reading of situations where this guy, Jim Simons, at some point, he was forced to intervene when his system was, which was working so far, so well, started, acting very weirdly in the middle of a crisis. And the human manager had to jump in and sort of, because what happens is all this AI ML is based on what you call dead data, right? A lot of data. And the more history you have, the more the system is trained to act in a certain way. But what happens if you don't, I mean, a black swan is not in history by definition. A black swan is never in history. So what happens if black swans another, so COVID, no one expected. As late as December 2019, all analysts were predicting a fantastic 2020, which turned out to be fantastic, but for a different reason, right? In terms of coming up and coming down and going up. So I think that is my answer. One is human beings are the ones coding the systems, and 2, the proliferation of algorithms can make it actually quite not so good for the markets. It amplifies market volatility, right? So while theoretically it's good to say they are unbiased, unemotional, which is true, but then there are some downsides of that as well.
Thank you, Vinod and Anubha. Yes, we have certain downsides with the algorithmic trading, and once it goes wrong, it can just cause havoc. I think there were some cases when it caused the losses of 400 million for one of the fund. I can't recall right now. But yeah, once that will also go wrong, it will be on a bigger scale as well, as compared to the human error. So overall, we have to probably control our emotional triggers and then work with the machine maybe in the future as a best combination. With this, I believe we can open the floor. We have been talking for an hour, and I'm sure the audience will have some fabulous questions as well based on their experience. So now back to the audience and everyone who has been listening to us patiently. Thanks for your time. And now we are ready for your questions. You can unmute yourself and you can ask your questions.
Hey, Nidish, can I go? Go ahead.
Sure, please.
Okay, so my question is about the last point that Vinod made, right? That the coding for the AI and ML algorithms is done by humans, right? But I think as an analyst or as an expert, you kind of already know what all these biases exist and what kind of decisions you should take based on your past experience. And I think typically whenever people use this machine learning kind of algorithms or develop machine learning kind of algorithms, they keep improving over the period of time as and when the data keeps increasing, right? So is it not a good idea to have some kind of algorithm to guide you before you take a personal decision? Because I think most of the time, as you said, we typically are driven by emotional biases while taking an investment decision or the decision to exit from somewhere, right?
Right.
So I think is it a better option that the ultimate decision is taken by human because so that they can take the ownership, but they are assisted by tools which are more AI driven or rationality driven?
Yeah, good question. So here's how it is, right? So AI in terms of investing is still quite new. It's still in nascent phase. So if you look at AI or ML or whatever you call it, right? Application can be, if you look at the various bits of investing, you can sort of see where the application is and where it works. So for example, if you're a retail investor and you want to find out what's your risk appetite, for example, you can use AI ML to help you, because they have based that assessment based on millions of investors, right? And that won't be far away. There are also systems that can help you decide on your asset allocation, your strategic asset allocation, right? How much should be invested in equities, how much should be invested in bonds, real estate, based on how they have profiled your risk appetite and return requirement. So that's also possible. Where it gets a bit tricky is when you talk about trading, right? At trading, so trading is based, or investing, whatever you call it, right? Investing or trading, that is based on a lot of signals from the market, right? Now the question is, can the system pick up the right signals on time? And then, like I told you, it's already been coded by somebody else. And then you have algorithms working in tandem around the market. And so as we speak, the market is still, the jury is still out on whether AI, ML can replicate at scale an efficient and effective trading investing system, right? I don't believe it's been done yet, because lots of gaps still exist in natural language processing and other areas, which it's probably better than a human being in terms of less emotional biases and even better, faster processing power and more memory. But the history is incomplete, right? And wrong signals can be picked up easily, right? So I think my answer would be, it's good in risk assessment, return requirement, good in asset allocation, but trading is far more complex than both those areas, the earlier two areas. And that's why we still have portfolio managers and fund managers and analysts doing that work, right? But I think at some stage you might get there where systems can basically scan through huge amount of data at scale and pick up patterns and basically, find out the nuances which human beings can sometimes pick up and invest accordingly. But till that is out, I would be very careful about basically relying on AI trading platforms.
So when do you think we'll get there?
I have no idea. I'm not an IT guy, technical guy, but okay. It's going to take some time. It's going to take some time. My view.
Just a loud thinking here. So if we all start relying on AI ML, then probably it can trigger the market in a different direction altogether. And then again, everything will fail. All sorts of then sentiments will come into play and all that. So again, imperfect markets and us.
No, but I think there the assumption is that everybody is going to use the same algorithm, which is not the case with the fund managers today, right? I mean, which is not the case with humans today. So I'm sure with AI algorithms also that distinction will always be there. Like everybody is going to have their own system.
Totally diametrically opposite. The data set is the same in public.
Yeah.
Yeah, that's my take. Thanks.
Okay. Thank you.
Pleasure, Manoj.
Right. So now we are ready for the next question.
So, Vinod, do you think AI and algo-based trading is the way forward? Because Kathy would definitely thinks that machines and artificial intelligence is, is far better than humans.
Right.
Yeah.
So I think everyone knows about Kathy Wood, right? And ARK Invest.
Yes.
Yeah. I mean, that, like I said, the jury is still out, Sushil, on that, to be honest, right? There are so many pros and cons about this. So there's an interesting guy called Hans Moravec, right? Moravec, Hans, Hans Moravec. You should read about him.
Okay.
He spoke about the landscape of human competence. And he said machines started basically like Excel, like adding, computing. Then they started getting into playing chess. They started getting into playing more advanced games than chess, like Go, for example, with AlphaGo, etc. with Google. Then they started getting into translating, a voice into text and languages, things like that, right? Now, social machines still haven't got to the stage where it can replicate a lot of other human functions. So humans are at a serious disadvantage when it comes to speed and memory. You know that, right? Compared to machines. But machines are at a serious disadvantage, at least as of today, when it comes to things like communication, culture, vision, empathy, and the tone of voice, things like that. I mean, it still haven't reached there. So the question is, will it reach there? And people are saying yes, it would. But like when Anubha asked me, somebody asked me, right, when will it happen? And Manoj asked, I don't know. It all depends on technological progress. But machines are getting, I mean, you would not have thought about self-driving cars or a lot of technology 20 years ago, right? Forget 10 years ago, right? Yeah. And so things are happening at scale, but we don't know how fast it's going to happen, right? But I think it will happen because it should happen, not will, because human interference in investing is disastrous, as you all know. Emotional biases, cognitive biases, memory problems all creep in. And that's basically destroyed portfolios. So I think, if a system can eliminate those biases and yet be robust at scale, then yes.
Yeah, and the other thing is that, look, if you're looking at a mutual fund, I mean, surely there is an investment committee which decides on, what is being proposed and whatever. So similarly, when you're looking at these so-called algos or whatever, whoever's developed them, there would be some due diligence around it, and people would look at it and validate it before it goes in. Of course, it's not foolproof. Certainly things can and do go wrong, but you expect a certain element of oversight over it before it's put into production. So, and then over period, I suppose they'll become smarter once there's history, there's data, as you said, it needs a lot of data. Yeah. So, okay.
So overall, look like that. Yeah, there's a both side of argument. If we lean towards the machine versus we stay with the human mind. But I believe the best combination can come when the human mind and the machine competence work in collaboration, because eventually, even when we look at the hindsight bias, somewhere it distort the probability. It says that, okay, if I had known this event, I could have taken the better decision. So those kind of issues are still with us. When we look at the past, we always feel that we have a very superior decision-making process. Machines will be more objective in those cases. There are some research which suggests that those who are better investor, better decision makers, they have less amount of hindsight bias. So we will continue to have those. But if we implement machine to analyze the data, make the decisions, and it can be validated by maybe an investment manager who has better overall understanding of the market, probably that combination can work better, right? Because ultimately, when it comes to the speed and accuracy, as Vinod said, the human mind is not the best. So machine can do that job better. But when it comes to the vision, overall interpretation, and general understanding, the human mind is much better. And that's why even Elon Musk and Apple, one of the founders, said that probably a 2-year-old baby can understand. If you tell once that it is a cat, they can remember, okay, how the cat may look like. But the machine can still make an error several times before it start to comprehend what a cat look like. So machine takes a lot of time to understand general, right?
Sorry.
So
I just
in
want to
terms
make a
of
point in
collaboration,
Nidesh, I think it's important. Sorry, yeah. So I think something's going to happen. Some other trend that I see happening, is already happening, by the way, is that you'll have in retail, in investing, you'll have retail investors and you'll have high net worth individuals, right? And I think AI ML will work perfectly for retail investors. But what you're going to see is that high net worth individuals are going to insist on, and they will get personalized service on their portfolios. So the market is going to bifurcate into two: one mass scale retail AI ML driven, and one for for the high net worth individuals, where it's a combination of systems, AI ML, and the personalized touch, right? So it's almost like economy class and first class in an airline or an airplane. And I think that makes perfect sense for banks, because banks are not going to be able to give personalized service to everyone. They're already under threat in terms of margin from fintechs, and the margins are going to shrink even further. So they are rapidly automating to reduce their fixed cost base and to reduce in regulation issues, et cetera, et cetera. So you're going to see that happening throughout the world. It's already happening in India, from what I know, where more and more of retail investors are being shown the way towards machine-driven solutions. Whereas people who have the money, whatever that money definition is bracket, you will get a combination of both machine derived and human involvement. That is natural. That will happen, right?
Absolutely. So next question, we are ready for any other query?
Hey, Dinesh, just one thing about the startup investments that Anubhav mentioned towards the end, right? That typically the investors would look at, I mean, most common things are like whether this problem is really big enough in the market so that they can get returns. What is the prodigy of the founders? And these are the typical parameters that we keep hearing about, right? Now the challenge there is, again, despite of that, we have seen that so many investments in the startups are not so successful in terms of returns, right? The portfolio of most of the VCs or Ps in the startup space always has, let's say, 1 or 2 unicorns, and then the rest of the stuff is like kind of almost unaccounted for. So my question here is, because nowadays the algorithms, the data, the information that's available is getting better and better, is it possible for the investment community to go the other way around, instead of just depending on founders to guide the journey of the startup and, let's say, learn from failures and then really find out a real problem that is monetizable? You already find a problem which is monetizable, there is a real need, and then you probably try to recruit the people who could fit in the founder's definition in that case, right? So that your ROI probably could get better. And I think for that, enough data is available in last at least couple of decades, I guess. So since the time IT has boomed, and most of the ideas are in the IT space to a large extent, whether it's fintech or health tech or anything, right? So in that space, there is always a lot of data available. What kind of startups failed because of what was the reason? What were the real needs and what were the perceived needs, right? So will startup community or the investor community look in that direction also?
Manoj, so let me clarify one thing very loud and clear. First of all, VC ecosystem works like that: 1 or 2 unicorns pressed, 80% fail, and 1 or 2 maybe a linear kind of a growth, not exponential. But then let us not, oversell the problem side. That there is a market, there's a real life problem, and there's an idea which is innovative enough to tackle that problem. Let us talk about execution. Let us talk about execution. Scale up is all about execution. Ideas could be there dime a dozen. I mean, once in a maybe in a decade or maybe in 20 years, you get something like a Facebook or something like I would say Microsoft. You won't get these kind of ideas every day. But rest of the ideas which are either copied. I mean, you just look at Paytm, the most valuable startup in India, is a copy of PayPal, but then because they've evolved. execution is the key. Execution, how you are going to scale up to the next millions of users, that's the key. So never fall in that trap of that idea is very good or this problem is there. Of course, that's the starting point, idea, and it has to be addressing a problem which is very real and which has a big market, huge scalable market. But then execution. That's the key. How the startup is going to fare in the long run. So execution comes from the strength of the team, and the strength of the team. No ML and AI can actually demystify it for you. You have to go by a bit of your hunch, bit of the qualification, a bit of the body language record, how they've performed earlier, all those stuff. So I don't think startup ecosystem, to some extent, of course, market analysis, that's fine. Trends, that's fine. But the execution capacity, it's a very, very subjective thing, and a lot of ideas and biases. So you meet investors who would say that I want this startup to work only on this particular thing. For the same startup, get ideas. Investors say that no, we want them to work on 2-3 problems, so that 2-3 domains, so that there's a risk mitigation. You're not putting all your eggs in the same basket. So there's going to be a lot of subjectivity in this domain for many years to come, I would say, because human beings are different. Everybody is different. Everybody behaves differently, different capacities, different competencies. So that's what startup investment is all about.
Okay. No, see, my question comes from the direction where instead of a startup, even a big company can also execute much better. But the problem with them is the agility, which they don't have, right? And they don't want to jump into execution of the problems, which seems to be not proven enough, not monetizable enough. They don't want to put resources which are agile, and they are more passionate about the problem rather than just executing based on their past experience, right? That's when the startups come into picture. Otherwise, startup would have never existed, any of them, right? I mean, all the problems in the world would have been always taken up by the execution machines, which are nothing but big services companies or big product companies, right? So now the thing is, this agility is definitely important.
I always tell my startups that never ever fall in love with the solution that you've built. So always fall in love with the problem that you set out to solve at the first place. Find ways and means, keep evolving yourself. Then only you'll have, that kind of solutions, which is going to scale up to millions of people.
Correct. But if you look at the startup success, right? No, if you look at the startup success, most of the startups which are not working well, even after investment, is because their problem statement is not so strong, or there is no real need in the market, right?
That's correct in a way, but then with the same problem statement, Facebook and Orkut had the same problem statement. I mean, just one example I'm giving you. So, and maybe, the food delivery apps, these Zomato, Swiggy, and you had Food Panda, 3 had the same problem statement. So who executed to what extent, how well, that is what mattered in the end. So yeah, of course, problem has to be very real. That's a starting point. But then how you are executing? Orkut, Facebook, that's the simplest example that comes to my mind. Same problems, same thing, same community, everything. Look at where Facebook is.
And we all were at a point with Orkut and moved to Facebook, and we forgot what Orkut was all about.
And Skype and Zoom for that matter. Skype and Zoom, as I said.
True. Okay, thank you.
All right, great.
Pleasure.
So now the next question, anyone else having a query on behavioral finance and any personal experience with this subject matter, please feel free to share. All right.
And in any case, you can touch base with us separately as well. Nidish, you can share our coordinates. So
yeah, definitely. So yeah, if anyone has any question or want to touch base with Anubha or her work on at Curriculum Venture, so you can always reach out to her on the LinkedIn, or you can let me know. I will introduce you all, as she has been doing a lot of great work in startup support, etc. Yeah.
Yeah, and you can reach out to me on my LinkedIn, guys. I'm quite active on LinkedIn. So just my name, Vinod Shankar, and reach out to me there or message me. Yeah.
Yeah, I will post your profile
Sure.
so that this audience can reach out. So if there's no other question, we can close the floor. And thank you so much, everyone, for joining for the session, and
Thanks,
also
everyone. Yeah.
Anubha and Vinod for your time and discussion. It has been enlightening and very insightful. So thank you so much, and we'll look forward to organize such sessions again in the future, and we'll keep visiting for the discussion. Thank
Bye,
you.
Anubha. Bye, guys.
Thanks for the
Bye.
opportunity.
Have a nice day.
Thanks for the
Yeah.
opportunity. Bye, guys. Have a great weekend.
Thank you. Nice
Bye.
weekend, everyone. Bye bye. Take care.
Bye. Bye from Patna.
Bye.
Bye.